Alright, welcome back to our exam one review. So where we left off, we determined that when the board of directors declares a dividend, but they don't pay it, that we create a dividend payable and we decrease retained earnings through the dividends account. So, and it's going to be none again for the type of transaction because there's no cash involved. So and now in the next transaction, we're paying $1,000 of the accounts payable that we created in the second transaction, or the third transaction, sorry. So we're paying $1,000, and obviously we know the other account is an account payable, so cash is going down. So in order to balance the accounting equation, we know that the liabilities have to go down. And this makes sense because if you pay somebody, you don't owe them that thing anymore, so thus the liability would go down. And this is going to be a financing activity. So pay dividend from earlier, so the 1500. So obviously we're paying something, so our cash is going to be going down again, 1500. And the liability is going to go down because we don't owe the shareholders anything anymore. And that is going to be a financing activity. All right, so now for this final one. So we perform services worth $100,000. So we already performed it, so we know that we earned revenue. As soon as we perform it, we earn the revenue. And in terms of goods, we earn the revenue when we deliver the goods. So that's the other part of the revenue recognition. And we know that it was worth $100,000, so we claim all that as revenue right away. But we only got 50,000 cash. So we know that we need another 50,000 somewhere on the asset or on like in assets to balance the accounting equation, and it's going to be an account receivable because they still owe us some of the money for the service that we perform for them. So after completing this, I actually want to go through the cash T account because I noticed going through chapter 4 that we were making some mistakes when doing T accounts. So let's make a cash T account quickly. So in transaction 1, we had a debit of 50,000. Transaction 2, we had a debit, or 4, we had a debit 8,000. And then cash is going down here for 500. Then it goes down again for 1,000. And then it goes down again for 1,500. I swear there's a point to this. Hold on. And now the last thing is a debit of 50,000. All right. So what I saw some of you guys do is like you would total both sides down here. So like this side would be 3,000 on the credit side. You just put 3,000 here, and then you'd put the total on this side. That's not how you are supposed to do it. So basically, you do something called you net them. So you're gonna like add up this side, and then you're gonna subtract the credit side. Because remember, cash has a normal debit balance, and we're never gonna have a credit balance in cash because we can't have negative cash. We can have a net loss, but we can't have negative cash. So remember again that cash and revenues and income are completely different. So the balance is going to be 105,000 on the debit side. That number is 10. In case you can't read it, it's this. So you just add up 50,000 plus 8,000 plus 50,000. You get 108,000, and you subtract 500 minus 1,000 minus 1,500, and we get 105,000. So that's how you do that. We shouldn't have a number on the credit side. We should only have a number on the debit side. So let's say if there was a liability, so we're going to have a number on the credit side, and then as we pay it off, the debit side is going to go down, but we're never going to have a debit balance for liabilities because that doesn't make any sense. It could be a zero balance, like we don't owe them anything, but we can't have a debit balance. So, and then like there would only be a number on this side for the liability. There'd only be a number on the credit side, not the debit side. All right, so after all that, let's move on to actually journalizing these. So start journalizing them, and don't worry about this adjusting entry. We'll do that once we finish journalizing this. All right, so receive 50,000 cash from an investor. So as we were saying up here, cash was going up, and so is common stock. So cash increases with a debit, and common stock is part of retained earnings. Retained earnings increases with a credit. I'm going to erase these, so if you want to like write them down, you can just pause the video and write them down, just for the sake of room, because it's hard to write small with a stylus. All right, so now in the second transaction, we purchased 7,000 worth of equipment by signing a note. It was the same transactions, by the way. So equipment, 7,000 is the debit. Note payable is the credit. Some people have asked what's the difference between an account payable and a note payable. A note payable has an interest component, so like we'll pay them the 7,000, but then we'd have to pay them a little extra too as like an interest expense. But we don't worry about that till like chapter 10, so you have that to look forward to. All right, so purchase $3,000 worth of supplies on account. So supplies, because we're getting supplies, so supplies are debited. From what I was seeing, you guys are pretty good at doing the journal transactions, so I'm really not too worried about this part of it. It's just extra practice. So received 8,000 cash for services to be performed. Remember, this is unearned revenue. Now, if I asked you what account this affected, what financial statements this transaction affected, it would be the balance sheet and the statement of cash flows only, because there's no revenue. So the income statement, it says revenue, but it's not a revenue account, remember, because it's unearned. So it's not really revenue, it's a liability. So next transaction, we paid $500 for the month's rent. So rent expense, credit cash for 500. Erase. Oh, geez. It's pretty loud, eraser. All right. Board of directors declare a 1,500 dividend, but don't pay it. Dividends. Credit dividends payable. Let's just go to the paying the dividend right away, so it kind of like makes more sense when you see it. So now we're clearing the dividends payable, so we're debiting it. Because remember, liabilities decrease with the debit, and then we're paying the cash. All right, so now let's go back to the paying of an account payable, which is kind of the same idea. Liabilities decrease with the debit, so we got debit accounts payable. And credit cash. Oh boy, I'm running out of time again. So this last one, we perform the services. We only get half the cash. So cash, accounts receivable, we're going to have two debits. You can have more than one debit or credit as long as the total debits and credits equal. So this is 100,000, 50,000. All right, so the last part of this video, or the third part, we'll do the adjusting entry. So